Hello and a very welcome to AE Accounting Tutorials. We are continuing our lesson on manufacturing accounts. In this particular video, I want us to take a full comprehensive practice question that will help us finalize our understanding on the preparation of manufacturing income statement and manufacturing statement of financial position. This particular question is comprehensive in such a way that it contains the concept of unrealized profits. That is where goods are transferred at selling price or market value. So we will try to understand how this unrealized profit will be treated in the manufacturing income statement and how it will be presented in the manufacturing statement of financial position. So let's quickly go through the question together and let's see how best we could understand this concept. The following trial balance was extracted from the books of Zilla Manufacturing Limited as at 31st December 2024. So we have capital $620,000. Stock at 1st January 2024, we have raw materials to be 135,500. Finished goods, 126,500. So the stock or the inventory is in two different folds. That is the raw materials and the finished goods. Take notes. We have purchases of raw materials, 3,376,500. We have purchase of finished goods, $200,000. We have carriage on finished goods, $1,000. We have freight charges on raw materials, $5,625. We have return on raw materials. We have return on purchases of raw materials, $11,125. We have factory wages, $500,000. Royalties, $32,300. We have factory lubricants to be $45,500. Factory light and heat, 19,950. Office light and heat, we have 14,300. Printing and stationery, $12,640. Postage and telephone is 10,200. Office salaries, $99,000. We have factory salaries to be 115,000. Factory insurance is 12,250. Other insurance is $45,000. We have display expenses of 66,800. We have advertising of 8,500. Discount allowed 7,000. Discount received 7,500. Sales 3,782,500. Provision for unrealized profits on 1st January 2024 is 11,500. We have land and building, $250,000. We have factory equipment and machinery. Cost is 250,000, and we have the net book value of 225,000. We have office equipment cost $50,000. We have $40,000 as carrying amount or the net book value. We have furniture and fittings, $25,000 at cost. We have 20,000 as carrying amount. Drawings is 34,260. Debtors and creditors. Debtors has to be 11,500. Creditors 13,200. Cash in hand is 27,500. Sales return is 4,000. The following additional information is relevant to the above accounting period. I. Finished goods transferred during the accounting period are transferred from the factory at cost of production plus 10%. This means the goods are transferred at selling price or market value. Good. II. Stock at 31st December 2024, we have raw materials to be $440,000 and finished goods of $170,500. III. Provision for depreciation rate is 10% per annum on all cost of non-current assets purchased by the company, excluding land and building. It means we have to depreciate all non-current assets by 10%, but we should exclude land and building. Required. Prepares a manufacturing account and income statement for the year ended 31st December 2024 and statement of financial position as at that date. This particular practice question is very comprehensive because it contains every single transaction that's supposed to be included in a normal manufacturing account question. Now, after going through the question, the next thing to do is to analyze the footnotes. The first footnotes inform us that the goods are transferred at selling price. Okay, that is, goods are transferred at cost of production plus 10%. The 10%, it is the profit margin. So when we are presenting our solution, we have to take that into consideration. The next thing we have to also consider is the closing inventory, the closing stock. They are given in two different forms. We have the closing stock of raw materials and closing stock of finished goods. Good. Then we are note that all non-current assets are depreciated at a rate of 10%, excluding land and building. It means we will not depreciate land and building. In a normal circumstances, for land, we don't even depreciate it because of time value for money. If you acquire land today, in the next 5 years, the price of that particular land will go up instead of coming down. This means that if you are depreciating your land, you are making a mistake. For accounting purposes, we don't depreciate land. But if building is included, we depreciate building. But this particular question is noting us not to depreciate land and building. Is that okay? Good. Now, I normally tell my students that in solving manufacturing account question, after going through the question, you have to determine what we call the cost structure, because the manufacturing account itself is basically prepared to determine a cost of production. So you have to first of all determine the cost structure. Now, in solving this particular question, you have to write the name of the company, that is Zola Manufacturing Limited. Then the first requirement, that is I, we should prepare a manufacturing account and income statement for the year ended 31st December 2024. This is two combined accounts. We have the manufacturing accounts and the income statement. Is that okay? Afterwards, we look at the statement of financial position. I said first determine the cost structure, because the manufacturing account is prepared to ascertain what we call the cost of production. So if that is the case, what are the components of cost of production? Now, we established that prime cost and factory overheads. Factory overheads. These two components will give us what we call cost of production. Is that okay? Good. And we are preparing this manufacturing account to ascertain this cost of production. So what makes up prime cost? Prime cost is made up of direct material cost, direct labor cost, and direct expenses cost. So when we sum this, we will get this. The factory overheads also talk about the indirect material cost, indirect labor cost, and indirect expenses cost. Now, I normally tell my students that when we add all this, we arrive at cost of production. But all from here up to here are normally given in the question straightforward. But the direct material cost that is used in the production process will not be given. So you have to determine that. Is that okay? So we always begin by determining the direct material cost. So to determine the direct material cost, we begin with the opening inventory of raw materials. We are saying we are determining direct material cost. So everything we look for is a material in nature. So we begin for raw materials. So for raw materials, when we look through the question, you will begin with what we call opening stock. When I talked about opening stock, I'm talking about the opening stock of raw materials, because we have two different opening stock. We have opening stock of raw materials and opening stock of finished goods. Is that okay? So now our focus is on raw materials. That is why the raw materials is up there. So opening stock of raw materials from the question is an amount of 135,500. So we write 135,500. Okay. The next thing to do is to add our purchases of raw materials, because the opening stock of raw materials might not be enough to meet our production process. So if there is any purchases of raw materials, we add it. So we add purchases. And these purchases I'm talking about is a raw material. So purchases of raw materials. And the amount from the question is 2,736,500. So 2,376,500. This is the raw materials purchased. Now, is there any cost that is incurred in bringing the raw materials into the premises of the business? Yes, that is what we call freight charges. It's more or less like the carriage invoice. Okay, so the freight charges are the cost incurred. It's like transportation costs. Is that okay? Good. So we also add freight charges. So when we look through the question, the freight charges is 5,625. So 5,625. This is the freight charges. So after adding this, we have no other costs, direct cost that is incurred on these purchases. So when we add these two, together, we arrive at 2,382,125. So 2,382,125 this way. Good. It means we are making adjustment on these purchases. Now, is there any adjustment that we're supposed to make on these purchases? Yes, from the question we have returns on raw materials, return on purchases of raw materials. So that is like return outwards. So, but note, everything we pick here is on raw materials. Good. So return on purchases. Return on purchases of raw materials. And the amount is 11,125. So $11,125. Whenever we make return, we subtract. So less return of purchases on raw materials. Good. Now, when we subtract this, we arrive at an amount of 2,371,000. So 2,371,000. This particular amount is the net purchases. Net purchases of raw materials. So net purchases of raw materials. Very good. So after arriving at the net purchases, what we do is that we add it to the opening stock of raw materials. So we add these two amounts together and we arrive at an amount of 2,506,500. So 2,506,500. And when we add the net purchases to the opening stock, we arrive at cost of raw materials available for use. So this is the cost of raw materials that is now available for use. That will be used in the production process. Is that okay? Good. Now, what we have to consider, is there any closing stock of raw materials? Yes, there is a closing stock of raw materials from the question. So we also list closing stock or inventory of the raw materials. You can see that from the question. That is add additional information. The closing stock as at 31st December 2024. Is that okay? Good. So the closing stock value from the question is $440,000. So $440,000. We are lessing, so I put it in brackets. So when we subtract this from this, we arrive at 2,066,000. Is that okay? So 2,066,000. Very good. So this now become the cost, the direct material cost. That is the cost of raw material consumed or used in the production. So cost of raw materials consumed in the production process. I say this is the direct material cost we've determined, as we can see from here. Is that okay? Good. So after determining this, we have to determine prime cost. After we have determined the direct material cost, let's look for any direct labor cost in the question. From the question, we could see what we call the factory wages. It's a direct labor cost. Okay, so we have factory wages. And this factory wages from the question is 500,000. Good. That is all of the direct material cost. Is there any direct expenses cost? Yes, there is a royalties. So I will say this is a direct labor cost. Is that okay? Good. So we also have royalties. Royalties from the question is 32,300. 32,300. And this royalties, it is the direct expenses cost. And we are saying that when we add these three items, we arrive at what we call the prime cost. Is that okay? Good. So what we are going to do is to add this 1, 2, 3. We add them together. So we arrive at 2,598,800. So this now become the prime cost. The prime cost. Is that okay? Good. Now, after determining the prime cost, the next thing to look for is the factory overheads to determine our cost of production. Is that okay? So we move to what we call factory overheads. Factory overheads. Good. Because the combination of or the addition of prime cost and factory overheads will now give us the cost of production. And that is basically the reason why we prepare what we call a manufacturing account. So when we look through the question, we have to identify factory overheads. Factory overheads are those indirect costs that are incurred in the production process. So I said it is the indirect material cost, indirect labor cost, and indirect expenses cost. From the question, we have what we call factory lubricant. And this factory lubricant, it is indirect material cost. Good. So, and the amount is 45,500. So I will say factory lubricant. And I said this is indirect material cost. Is that okay? And this is 45,500. Good. Listen, this indirect cost that are incurred in the production process, we are only considering the indirect cost relating to factory. There could be other indirect costs like let's say we have other insurance which is not related to factory. We will not bring it here. We are talking about indirect costs that are incurred as a result of the factory. Is that okay? So everything we bring here is about factory. The next one to look for is factory light and heating. Is that okay? Factory light and heating. So we have factory light and heat. Good. And factory light and heat is an indirect expenses cost. Is that okay? And the amount is 19,950 from the question. So 19,950. Good. From the question, we could see factory salaries too. Okay, of 115,000. 115,000. Yes. So we have factory salaries. Factory salaries or factory salary. And the salary is also indirect labor cost. Okay, and the amount is 115,000 from the question. 115,000. The next factory overheads in this question is factory insurance. Okay, factory insurance. So we have another factory insurance. And factory insurance is an indirect expenses cost. It's an expense, right? And the amount from the question is 12,250. So 12,250. Good. Because of the space, I would like to clean here so that we proceed with the um, factory overheads. Good. Now, the next factory overheads in this particular question is in the footnotes or the additional information. That is depreciation, okay? But the depreciation here is the one relating to factory. So if an asset is not actually used for the factory alone, we cannot depreciate it under the factory overheads. When you look through the trial balance, you could see that there is a factory equipment. So it is this particular factory equipment that we are going to depreciate over here. So if a non-current asset is not purposely for the factory, we will not depreciate it here, but we will depreciate it elsewhere. So follow me as we do it. So depreciation, okay? So we talk about depreciation of factory equipment. Good. And the depreciation rate is 10%. Now we look for the cost because we have to depreciate non-current asset on cost. Is that okay? So the cost of the factory equipment is 250,000. So 250,000. When we depreciate it by 10%, we will have 25,000. Good. So we will have 25,000. What we have to do is to add this to this. Is that okay? So when we add that, we will get 217,700 from our calculator. So when we add, we will arrive at 217,700. Good. That is the addition of all the indirect cost. That is the factory overheads. Now we add this factory overheads to the prime cost. That will give us the cost of production. So cost of production. Sorry, production. So cost of production, as I said, will be the summation of the factory overheads and that of the prime cost. Is that okay? And this will give us 2,816,500. So 2,816,500. Good. And this cost of production is the reason why we are preparing the manufacturing accounts. Is that okay? Good. Now, take note that this cost of production will be transferred to the selling department or the finished goods. That is where we are. In order to prepare the income statement, we will transfer this cost of production, okay, as our purchases. But note, the additional information is telling us that this cost of production is transferred plus 10%. This 10% is the profit margin on this production. Okay, so when there is a profit margin, it means that the goods will be transferred at a selling price or a market value. So we have to calculate the 10% on this as the manufacturing profit. Good. So we will have a manufacturing profit or manufacturing profit. The manufacturing profit will be is 10%, right, from the question multiplied by the cost of production. So 2,816,500. Okay, so when we do this, we will arrive at this. We only take off 10. So 2,816, yes, 50. So this will be 281,650 as the manufacturing profit. So when we add the manufacturing profit to this, we will arrive at what we call a market value. When we add these two, or the selling price of the product. Okay. And when we add these two, we will arrive at an amount of 3,096,150. So 3,098,150 this way. This amount becomes the market value. The market value. Very good. So because there is a manufacturing profit, now we will transfer the market value to the finished goods instead of the cost of production. Is that okay? Finished goods. Okay. Then now we are to look at sales, okay, because we are to determine the profit or loss on this transaction. So we begin with our sales. The sales from the question is 3,782,500. So 3,782,500 as the sales value. Now, is there any sales return? Yes, in the question, you could see that, and the sales return is 4,000, and with less sales return. Is that okay? So when we less sales return, we arrive at 3,778,500 as the net sales. Good. Now, because of the space, I would like to clean here, then we continue from there. Is that okay? Good. So less cost of sales. So the cost of sales, we still begin with the opening stock. But this time, it is the opening stock of finished goods, not raw materials. Is that okay? Good, because we are at the income statement level. We have opening stock. Opening stock. So this opening stock is the opening stock of finished goods. So from the question, it is 126,500. 126,500. After this, we add purchases. That is for normal trading accounts. But because it is a manufacturing concern, instead of purchases, we add what we call the market value because the goods are transferred at market value. Add market value. And the market value is 3 million, 3,098,150. Good. So this represents the purchases figure when we are preparing like a normal income statement for sole traders. But note, in solving a manufacturing account question, if there are no external purchases, then we leave it this way, then we proceed. Okay. But in this particular question, there is an external purchases, that is purchases of finished goods. So the purchases of finished goods is the external purchases here. So we also add external purchases. External purchases. And that is an amount of 200,000. 200,000. Good. Now, is there any other adjustment on purchases? From the question, there is a carriage inwards. Carriage on finished goods. Is that okay? Good. So everything we do here is under finished goods. So we add carriage. Carriage on finished goods. Okay? Or carriage inwards. Carriage on finished goods. Or the carriage inwards is an amount of 1,000. Good. So now we add this three. We arrive at 3,299,150. This represents net purchases of the finished goods. Is that okay? Now we add the net purchases to the opening stock of finished goods. 1,650. This way. You can get that when we add these two on your calculator. And this represents the costs of goods available for sale. Good. Now we less our closing inventory or closing stock. This closing stock is the closing stock in the footnotes from the question is 170,500. Then we subtract this amount. So when we subtract this from this, we arrive at 3,255,150 this way. And this becomes the cost of sales. Is that okay? So cost of sales. The cost of sales. So the cost of sales, permit me to write it under the last sign as 3,255,150, so that I clean this. Now we subtract the cost of sales from the net sales. We arrive at 523,350. So 523,350. This represents the gross profit. The gross profit. Okay. Now, after determining the gross profit, now we add other incomes. Take note, the manufacturing profit we've calculated for is one of the other income. So the manufacturing profit we've calculated for is 281,650. So by adding other incomes, we have manufacturing profit. We just calculated for that. The manufacturing profit is 281,650. Good. When we look through the question, there is another other income, that is discount received, and the discount received from the question is 7,500. So we also add discount received, 7,500, and that is all with the other incomes. So we add these two to get 289,150 as the total other incomes. Now we add the other income to the gross profits, 812,500 as the total income. Okay, after adding other income to the gross profits. Now let's less the operating expenses. But in manufacturing accounts, the expenses are categorized into three. We have administration and general expenses, we have selling and distribution expense, and we have finance cost or finance charges. So I'll group them as such. Now, these particular expenses should not be in relating to the factory, but rather in the administration sector. Is that okay? So we have office, light, and heat. So office, light, and heat. The office light and heat is 14,300 from the question. Okay, 14,300. From the same question, we have printing and stationery. So printing and stationery. Printing and stationery is 12,640. And we also have postage and telephone. So postage and telephone. Postage and telephone is 10,200 from the question. Good. From there, we also have office salaries. From the question, office salaries. Office salary is also 99,000. Then we also have other insurance. Remember, we have factory insurance and other insurance. The factory insurance has been captured under the factory overheads, but the other insurance will be under administration and general expenses, and that is an amount of 45,000. Now, there is one thing we have to talk about under administration and general expenses is the depreciation. The depreciation of non-current assets that are not only used for the factory. Is that okay? Good. So I will talk about depreciation. Good. So with the depreciation, we have equipment. Is that okay? That is office equipment. So office equipment, the rate is 10%. Now remember, we are depreciating the asset on cost. Is that okay? So the cost of the office equipment is 50,000. So when we depreciate this, we will get 5,000. Good. Then the next is furniture and fittings. So okay, the furniture and fittings is also 10%, but this time the cost is 25,000. We are depreciating on cost, and this will give us 2,500. Good. So we are done with all expenses that falls under administration and general expenses. Now we add them. Okay, so when we add all this, we will arrive at 188,640. Good. As the total expense for general and administration. Now we move to selling and distribution. Good. Selling and distribution. Distribution expense. Good. Under this selling and distribution expense, the very first expense I would like to talk about, it is the provision for unrealized profit concept. There can be a situation where the provision for unrealized profit will result in an expense or an income. Listen and listen good. Anytime there is an increase in provision for unrealized profit, the difference is an expense. That will come under the selling and distribution expense. But if there is a decrease in provision for unrealized profit, the difference will be added to gross profit. Now, in order to determine the provision for unrealized profit, there is a formula for that. So let's work that out. Provision for unrealized profit. In summary, it is the manufacturing profit. This is the formula I'm giving you. The manufacturing profit over the market value or the selling price of the goods transferred. So the market value multiplied by stock or the closing stock of what? Finished goods. Not closing stock of raw material, but then finished goods. Now, the manufacturing profit we have calculated for in this particular question, the manufacturing profit is here 281,650. So 281,650 over the market value. So the market value we've also determined 3,098,150. So 3,098,150. When you are following, you get to know where we got the market value from. Then we multiply it by the closing stock of finished goods. That is right in the question under the additional information. And the closing stock of finished goods is 170,150 this way. So when you punch this on your calculator, you will get $15,500 as the provision for unrealized profits. Now, take note that the provision for unrealized profits in the trial balance is 11,500. 11,500. This is the previous one. Now we've calculated for current provision for unrealized profits. We had 15,500. Now, sorry, 15,500. What is the difference? Ask yourself, is there an increase or decrease? Yes, there is an increase in provision for unrealized profits, and the difference is 4,000. This 4,000 is an increase in provision for unrealized profits. So an increase for provision for unrealized profit, the difference will be considered as an expense, and that will be treated under selling and distribution. Is that okay? Now, to get this concept very well, I would like to present this in a T format. I will have my provision for unrealized profit account this way. Good. Listen, provision itself, it is an amount of money that is set aside for future circumstances or future liabilities. And the provision for unrealized profit, it is the profit that you have added on the goods, okay? And at the close of the period, all the goods were not sold. There is a closing stock. So there is a profit margin that is not yet realized. So we call that provision for unrealized profit. So that amount is an income, but you did not yet receive it. So it will have a credit balance. So the first provision for unrealized profit in the trial balance, it is the previous one. So we call that a balance brought forward, and it's 11,500. Good. At the close of the period, when we calculated for provision for unrealized profit, we had 15,500. This means this will be the balance brought down. Every balance brought down has the same balance CD. So we will have a balance CD or carry down of 15,500. So when we close this account this way, this carry down must be a brought down over here as balance brought down of 15,500. So to balance up this account, the total is 15,500, right? 15,500. The debit side is bigger than the credit, so the difference here is 4,000. And this amount will go to profit and loss account or the income statement. It means we have to debit profit because it is at the credit side of provision for unrealized profit account. It will be at the debit side of profit and loss account or the income statement. That is why we are debiting profit and loss account or the income statement with the difference, which is 4,000. Because see, this 4,000 is the same as this. I hope the concept is now clear. Good. So that is the concept of provision for unrealized profit. So the provision for unrealized profit is some provision for unrealized profit, but you write it in full. Provision for unrealized profit is 4,000. But one thing I want you to take note that when we are determining the calculation over here, we had a balance brought down of 15,500. That is the balance brought down. This balance brought down will be treated in the statement of financial position. It will be, we will subtract it from the closing stock of finished goods and the current assets. Okay, so the current provision for unrealized profit you've worked for or calculated for, when you are preparing a statement of financial position, you subtract it from the closing stock of finished goods under current assets. Is that okay? Good. So that amount is 15,500. Take note, you subtract this from closing stock of finished goods under the current assets in the statement of financial position. Good. So after determining the provision for unrealized profit as selling and distribution expense, the next to look for in the question is display expense. We also have a display expense. A display expense is like advertisement. You are displaying the cost you incurred in displaying the product for customers to see. So we say displaying expense. Okay. And from the question, the amount is 66,800. 66,800. Now we have advertising. Advertising fall under selling and distribution. So advertising, and the cost is also 8,500. So that is all. We add this three. Okay. So when we add this three, we will get 79,300. The very last category has to be the finance cost or finance charge. Administration and general expense, selling and distribution, and finally the finance cost or finance charge. Financial charges. Under financial charges, we have only one. That is discount allowed. Discount allowed. And the discount allowed is an amount of 7,000. So we bring the 7,000 over here. Now, the next thing to do is to add these three expenses together. Is that okay? Good. So when we add these three expenses together, we will arrive at 274,000 940 as the total expense. This now becomes the total expense or expenses. Yes. Now the total expense will be subtracted from the total income. This is also a total income after adding the other income to the gross profit. Now we subtract this total expense from the total income. 537,560. And this amount becomes the net profit. Very good. The net profit. Now we are done with the first requirement, the net profit. The net profit is ascertained by subtracting the total expense from the total income. Now, the next thing to do is the statement of financial position. Very simple one. We use about 5 to 6 minutes to complete that. So follow me as we do that. Okay, so the final requirement is the preparation of the statement of financial position. And this is very simple. The only tricky aspect over here is on how to calculate the accumulated depreciation. Is that okay? Good. So now we begin with the non-current assets. We have 4 different non-current assets in this particular question. We have land and building. So we have land and building. And the cost from the question is 250,000. And remember, from the very final additional information states that we should depreciate all non-current assets at a rate of 10% on cost, but we should exclude land and building. So it means on land and building, we won't depreciate it. And there is no accumulated depreciation of land and building in the question as well. So we have no accumulated depreciation. So the net book value or the carrying amount is the same, 250,000. We move to the next non-current assets, that is factory equipment and machinery. So we also have factory equipment and machinery. Good. And the factory equipment and machinery, the cost is also 250,000. Here we are recording only the cost, not the carrying amount or the net book value under cost. So the cost is 250,000. You can see from the trial balance from the question that this particular asset, we have the cost in brackets before another value in the trial balance. The value in the trial balance, it is the carrying amount or the net book value of that particular asset as at that point in time. Is that okay? So the reason why there is a difference is that there is a depreciation or accumulated depreciation. So in order to get that accumulated depreciation, for instance, when we pick factory equipment and machinery, the cost is 250,000, right? 250,000 this way. But there is also another value in the trial balance, 225,000, right? This is what we call the cost, and this is the net book value or the carrying amount. So when the difference between cost and net book value is what we call accumulated depreciation. So when we subtract this from this, we will have 25,000. This 25,000 is the accumulated depreciation. But remember, in the current year we are working with, we've calculated depreciation on the factory equipment and machinery. Okay, that was under the factory overheads when we are preparing the manufacturing accounts. So we worked 10% on the cost and we had 25,000. We worked 10% on this and we had 25,000 as the current depreciation. And take note, we have accumulated depreciation, previous depreciation as this. So the current one also 25,000. By multiplying the 10% on this, we've done that under the factory overheads. So now to get accumulated depreciation, we add these two as 50,000. So the accumulated depreciation for factory equipment and machinery is 50,000. So the net book value or the carrying amount is 200,000. Good. Now we move to the next one, which is office equipment. So we also have office equipment. From the question, the cost of office equipment is 50,000, right? So we record the cost under cost 50,000. Now, there is a net book value of the office equipment in the trial balance. Okay, and that net book value is an amount of 40,000. So the cost being 50,000, then we subtract the net book value of 40,000. We have a difference of 10,000. This difference is the provision for depreciation or accumulated depreciation. Now, we've also worked another depreciation for the current year. That is under administration and general expenses, 10% on office equipment, 10% on cost, we have 5,000. It means we will add this 5,000 as current depreciation to the accumulated depreciation to get 15,000 as the total accumulated depreciation. And we will record that over here under accumulated depreciation as 15,000. So the difference will be 35,000. I hope this is clear. The next is furniture and fittings. Furniture and fittings. Furniture and fittings, the cost is 25,000. We record that under cost. And it has a net book value of 20,000. So the difference between 25,000 and 20,000 is 5,000, right? This way. Good. Now remember that the furniture and fittings we provide for depreciation under the current year. That is 10% on cost. We have 2,500 as the current year's depreciation. So to get the total depreciation, we add the current year's depreciation of 2,500 to the accumulated depreciation of 5,000, and this will give us an amount of 7,500 this way. So we subtract this from this and we will get 17,500 as the current amount. So now we just have to add the totals. When we add this, we will get 575,000. We add this to it, we have 72,500. We add the net book value figures, we will get 502,500. We close the cost, close the accumulated depreciation, and leave the net book value because we will use it. Now, after dealing with the non-current asset, we move to the current assets. And the current assets are arranged in terms of liquidity. Remember, so we begin with our stock or inventory. And this stock is the closing inventory. Listen and listen good. With the closing inventory, we have raw materials. And we also have finished goods. The closing inventories are two, okay? So finished goods. From the footnote, we had raw materials to be an amount of 440,000. We record that 440,000. Then the finished goods figure is 170,500. I recorded it under the first currency sign because there is an adjustment that we need to make on this. Costs or closing inventories are recognized at cost. Is that okay? Or inventories are recognized at cost in the statement of financial position. But remember, this closing inventory, there is a profit margin on this that is not yet realized. It means that this is not cost, this is at market value, or this is at selling price. And IAS2 prescribe the treatment of inventory or stock that we should value it at cost or lower of cost or net realizable value. So we have to value this inventory at cost, not at selling price, neither a market value. So the profit margin that is on this, we have to subtract it off. That is the unrealized profit, provision for unrealized profit we've calculated for. Remember, in our workings, we worked for provision for unrealized profit, and we had an amount of 15,500 as the provision for unrealized profit brought down. Okay, and I told you that will be treated in the balance sheet or statement of financial position. So you will come and say provision for unrealized profits. You write it in full is 15,500. we will subtract so that the closing stock will be valued at cost according to IAS 2. Good. So when we subtract this from this, we will get 15,500. Is this clear? Then we move to the next current asset, that is debtors. Debtors means account receivables. Good. Account receivables in the question is 11,500. Very good. We are arranging this in terms of liquidity. Remember, we have cash in hand as the next non-current asset of an amount of 27,500. So 27,500. That is all with the current asset. We add them up. When we add this four, you will get an amount of 634,000. Okay, so 634,000. From here, we move to what we call the current liabilities. So current liabilities. Remember, this approach we are using over here is the net total asset model or approach, or the working capital model. Is that okay? Basically, we have three models or approach for preparing the statement of financial position. We have total asset model and all that, but we are using the working capital model. So we will arrive at what we call a working capital over here. So under the current liability, we have creditors or accounts payables, and that is an amount of 13,200 from the question. The working capital approach permits set off. So we are allowed to set off our current liability, total current liability from the current assets. Now we have only one current liability. So when we subtract, we will arrive at a figure that we call a working capital. So the difference between this and this is 620,800. So 620,800. So we call this figure a working capital. Good. Now we add our working capital to the total non-current assets. Okay. And this will give us 1,123,300. So 1,123,300. Good. So this is the net total assets. Is that okay? Good. This is one of the balancing figure. So let's look at the finance by the other aspect of the equation. Okay, good. So I want to continue from here. So with the finance by, we begin with our capital, and the capital is given straightforward in the question. So we have capital, and the capital from the question is 600,000. So we write our capital 600,000. Then we add our net profit. The net profit that we ascertained in the manufacturing account and the income statement, and that was an amount of 537,560. So 537,560 as the net profit. So we have to add these two. So when we add these two, we will get 1,137,536. So 1,137,560. After we add our net profit, the next thing to do is to consider if there is any drawings. And from the question, we have drawings, okay? And the drawings is an amount of 34,260. So the drawings amount is 34,260. Yes, 260 from the question. So we subtract drawings. And when we subtract this from this amount, you will get an amount of 1,103,300. So 1,103,300. Very good. Now, the next thing to consider is the non-current liabilities. So we have non-current liability. And the non-current liability in the question is the long-term loan. The long-term loan in the question is 20,000. So we add the 20,000 to this, and this will give us an amount of 1,123,300. And this amount is the capital employed. You could see that the capital employed is the same as the net total asset. It means the statement of financial position has balanced. Is that okay? So basically, this is how we go by a complete manufacturing account question. If this video is useful to you, don't forget to subscribe to this channel. Comment on this channel for us to know how this video has helped you. Share this video to other colleagues to also join the platform in order to make the platform very big and bigger. Thank you and see you in our next video.